Strategic approaches to market crashes. Optimizing your investments for stability. In today's unpredictable financial landscape, it is crucial to have a well-thought-out plan in place to navigate through market crashes. A market crash can significantly impact your investments and financial stability if you are unprepared. This article aims to provide you with a comprehensive guide on how to survive a market crash. By following these strategies, you can safeguard your investments and minimize the negative effects of market downturns. Understanding market crashes. A market crash refers to a sudden and significant decline in the overall value of financial markets. These downturns can be triggered by various factors, such as economic recessions, geopolitical events, or investor sentiment. Market crashes can lead to a sharp decline in stock prices, widespread panic selling, and a general sense of financial instability. Assessing your risk tolerance. Before formulating your plan to survive a market crash, it is essential to assess your risk tolerance. Understanding how much risk you are comfortable with will help you make informed investment decisions. Consider your financial goals, time horizon, and personal circumstances to determine your risk tolerance. This assessment will guide you in creating a balanced investment portfolio. Diversify your portfolio. Diversification is a key strategy to mitigate the impact of a market crash. By spreading your investments across different asset classes, sectors, and geographic regions, you can reduce the risk of substantial losses. A diversified portfolio should include a mix of stocks, bonds, cash, and alternative investments. This approach helps cushion the impact of market volatility and ensures that your investments are not overly concentrated in a single area. Maintain a long-term perspective. During a market crash, it is crucial to maintain a long-term perspective. Markets have historically recovered from downturns and delivered positive returns over the long run. Avoid making impulsive decisions based on short-term market fluctuations. Stick to your investment plan and remain focused on your long-term financial goals. Keep an emergency fund. Having an emergency fund is essential to weathering a market crash. Set aside an adequate amount of cash that can cover your living expenses for at least 3 to 6 months. This fund provides a safety net during challenging economic times, allowing you to avoid tapping into your investments prematurely. Stay informed and educated. Stay informed about market trends and economic indicators. Regularly follow reputable financial news sources and keep an eye on factors that can influence the market. However, avoid getting caught up in sensationalized news or making impulsive investment decisions based on short-term headlines. Educate yourself about investment strategies, risk management, and market fundamentals to make informed decisions. Avoid panic selling. One of the most common mistakes during a market crash is panic selling. Emotions can cloud your judgment, leading to irrational decisions. Selling investments at the bottom of a market downturn locks in losses and hampers your ability to recover when the market rebounds. Instead, stick to your long-term investment plan and focus on the underlying fundamentals of your investments. Remember that market downturns are temporary and that historically, markets have shown resilience and the ability to recover. When faced with a market crash, it is essential to resist the urge to make impulsive decisions driven by fear or panic. Instead, take a step back, assess the situation objectively, and remind yourself of your long-term investment goals. Panic selling often leads to selling at the worst possible time, crystallizing losses and missing out on potential gains when the market eventually rebounds. Stick to your long-term investment plan, which should be based on careful research, asset allocation, and risk management. Ensure that your portfolio is diversified across different asset classes and sectors, as this can help mitigate the impact of market volatility. By maintaining a disciplined approach and staying focused on your long-term goals, you increase your chances of weathering market downturns and benefiting from future market recoveries. Remember that successful investing requires patience, discipline, and a long-term perspective. While market crashes can be unsettling, it is important to keep a calm and rational mindset. Avoid being swayed by short-term market fluctuations and focus on the fundamental factors driving the value of your investments. By avoiding panic selling, you give your investments the opportunity to recover and potentially grow over time. Remember, investing is a marathon, not a sprint. Stay committed to your investment strategy. Stay informed and seek advice from trusted financial professionals if needed. Consider buying opportunities. During a market crash, there may be attractive buying opportunities. As stock prices decline, certain investments may become undervalued. If you have cash reserves or the ability to invest, consider purchasing quality assets at discounted prices. However, exercise caution and conduct thorough research before making any investment decisions. Review and rebalance your portfolio regularly. Regularly reviewing and rebalancing your portfolio is crucial, especially during volatile market conditions. Reassess your asset allocation and adjust it to align with your long-term goals and risk tolerance. If certain investments have become overweight or underweight due to market fluctuations, rebalance your portfolio by selling or buying assets accordingly. Seek professional guidance. If you are uncertain about navigating a market crash or lack the expertise to manage your investments effectively, consider seeking professional guidance. Financial advisors and investment professionals can provide valuable insights and help you create a tailored plan based on your individual circumstances. They can offer expertise, provide objective advice, and assist in making informed investment decisions. Maintain a disciplined approach. Discipline is key when surviving a market crash. Stick to your investment strategy and resist the urge to make impulsive decisions based on short-term market movements. Emotional reactions often lead to poor investment choices. Remember that successful investing requires a long-term perspective and the ability to stay disciplined even during turbulent times. Protect your investments with stop-loss orders. Implementing stop-loss orders can help protect your investments during a market crash. A stop-loss order is a predetermined sell order that automatically executes when an investment reaches a specified price level. This order helps limit potential losses by selling your investment if its value declines beyond a certain threshold. By utilizing stop-loss orders strategically, you can safeguard your portfolio against significant downside risks. Keep cash on hand. Maintaining a cash position is essential during a market crash. Having cash on hand allows you to capitalize on investment opportunities that may arise and provides a buffer for any unexpected expenses. It also provides peace of mind knowing that you have readily available funds for emergencies or unforeseen circumstances. Consider alternative investments. Diversifying your portfolio beyond traditional stocks and bonds is advisable during a market crash. Alternative investments, such as real estate, commodities, or private equity, can offer additional sources of returns and reduce overall portfolio volatility. However, it is crucial to thoroughly research and understand the risks associated with these investments before allocating capital. Stay calm and focus on the long term. Lastly, it is vital to remain calm and focused on your long-term financial goals during a market crash. Remember that market downturns are part of the investment cycle and patience is key. Maintain confidence in your investment strategy and trust that markets have historically recovered over time. By staying disciplined, diversifying your portfolio, and making informed decisions, you can survive a market crash and position yourself for long-term success. Conclusion: Surviving a market crash requires careful planning, discipline, and a long-term perspective. By following the strategies outlined in this article, you can minimize the negative impact of market downturns and protect your investments. Remember to assess your risk tolerance. Diversify your portfolio, stay informed, avoid panic selling, and seek professional guidance when needed. Additionally, maintaining a disciplined approach, utilizing stop-loss orders, and considering alternative investments can contribute to your overall financial resilience. Stay calm, focus on the long term, and remember that market crashes are temporary setbacks in the journey toward your financial goals. Frequently asked questions. Should I sell all my investments during a market crash? It is generally not advisable to sell all your investments during a market crash. Panic selling can lock in losses and prevent you from benefiting from a market recovery. Instead, focus on maintaining a balanced and diversified portfolio that aligns with your long-term goals. How long do market crashes typically last? The duration of market crashes can vary. Some market crashes may be short-lived, lasting only a few weeks or months, while others can extend for a more prolonged period. It is important to remember that markets have historically recovered from downturns and delivered positive returns over the long run. How can I protect my investments from a market crash? To protect your investments from a market crash, you can employ several strategies. These include diversifying your portfolio, maintaining a long-term perspective, having an emergency fund, staying informed, avoiding panic selling, and considering alternative investments. It is also advisable to seek professional guidance and review your portfolio regularly. What are some alternative investments I can consider during a market crash? Alternative investments that you can consider during a market crash include real estate, commodities, precious metals, hedge funds, and private equity. These investments may provide diversification and potentially lower correlation with traditional asset classes, offering additional protection during market downturns. However, it is essential to thoroughly research and understand the risks associated with these investments before allocating capital. Should I stop investing during a market crash? While market crashes can be unsettling, it is generally not advisable to stop investing altogether. In fact, market downturns can present buying opportunities for long-term investors. By sticking to your investment plan and carefully selecting quality assets, you may be able to capitalize on undervalued investments during market crashes. However, it is important to consider your risk tolerance and seek professional advice if needed.